Hello, hello, hello. This is Trader Travis, and I welcome you to another weekly recap. Peter and I had some scheduling conflicts, so we had to record our recaps as two separate videos. So I'm going to load up his first, but as usual, everything we're sharing is for educational, informational purposes only. We're not giving you investment advice. We're empowering you with education, and we hope that you can use that education to create financial freedom. So with that being said, let me drop you into Peter's recap, and then I will follow with mine directly after.
Okay, so welcome you guys. So Travis and I are doing separate recordings because we had a lot going on today, so we couldn't kind of match up our schedules. So I'm doing my recording. He'll slide this into his recording. So I'm just going to go through. I'm going to be real quick about mine. I'll just show you all my positions that I'm in. I'm going to start right off with Apple here. Now, if you guys have ever traded Apple, Apple can be a very difficult stock to trade. So if you're new to trading or you've just gotten into trading, I'd highly suggest you stay away from Apple just because it can really test your patience. However, if you want to really test your trading abilities, Apple's a good one to test it on. So I got into Apple because of a market club signal it got. And since I got into Apple, it's just kind of gone nowhere. I have a $200 call option. I also have a debit spread on Apple where it's the 200, 199 debit spread. And you can see Apple just kind of flirts with 200 and drops right back down. So the good news is I'm not losing any money. The bad news is, especially from a call perspective, I'm not really making any money. So, and as time ticks away, it's not good for me. So I still have plenty of time on that option. I have about 60 days left before I have to exit the trade. So I'm not concerned about it, but it's just something I wanted to point out that Apple can be it can be a very difficult stock to trade, and you have to be very careful with it. My next one I'm going to go into is Facebook. I have a credit spread on Facebook. And right now, again, this is another one that has, my credit spread still has a good 40 to 42 days left on it. Credit spreads are different than actual directional trades. So for it to just kind of meander in this 178, 180 range is okay for me. I need it to get above 180, so it's out of the money, but each day it just kind of sits and goes sideways. Doesn't hurt me. It actually benefits me because time ticks away from that credit spread. And as time ticks away and it stays at or around the money, I'm in a pretty good shape. And I can usually take it right out to the last week of expiration. But once it does hit an 80% return on my credit, I'll go ahead and exit it. And then, of course, I do have my exit strategy. If this thing hits a 50% decrease or a 50% loss, then I'll go ahead and exit it. But right now, Facebook is looking good. Again, I used Market Club to get into this. Market Club gave it a trade signal for me, so and it hasn't given me an exit signal, so I'm still good to go on that trade. Macys, many of you guys have known I've been in Macys. I've been trying to get out of it. One of the things I've kind of changed up on Macys, so I have a $24 covered call, which is in the money, and it's going to expire this week, and I'm probably going to buy that back at a loss. I will do that tomorrow morning. And the reason why is because Macys triggered on Market Club a weekly green triangle. So that tells me in the short term, at least, it wants to go up. And what I'm going to look for here, if Macys triggers another red weekly, then I'll go ahead and sell another covered call to hopefully get out of this position. If it doesn't, though, and it continues to kind of go up, or even if it just kind of meanders here, I'm just going to sit tight for a little while, because if a green weekly, sometimes green weeklies will convert over to a green monthly eventually, if the stock really does take off. You can see it kind of took off over here, and then it just kind of came back to its midterm average here, and it kind of bounced off of it. So I'm just going to wait and see what happens here. It doesn't hurt me to wait. Either way, this is a I own 100 shares of Macys at a higher price point. So either way, I'm going to lose money on Macys. So it doesn't make sense to. It's given Market Club has given me a signal that in the short term it's going to go up. So let's let it go up, and maybe I can get out of it at a little bit higher than $24. Maybe I can get out at $25 or $26. So that's where I'm at with Macys. This is a new position. I'm in Nike. Excuse me. I got yesterday. Nike triggered a weekly green. It's green across the board. Yesterday was a down day, so that's why I didn't get into it. You can see it was kind of red. It didn't know what it wanted to do. I don't usually like when prices are way above this, but this morning when I woke up and got into the market, I was like, well, it's an up day, so I'm going to get into it. Now, I do have to pay attention to its recent high of 89 over here, 89.90 bucks, and then it fell back down. So we'll see what happens. Right now, it's a vertical credit spread, so I got plenty of time on this trade. I had to go farther out. Usually I take my credit spreads about 45 days. I had to go farther out because I just couldn't get the open interest on my credit spread. So I did go ahead and do a 64-day credit spread. So I think I did 64. Let's see. Yeah, or 94. I had to do 94 because I just couldn't get the open interest on the shorter spreads. Normally I don't go that far out. Well, now it's showing higher open interest. It wasn't this morning, so I probably could have done a 66-day, but either way, it's not a big deal. I looked at it and said, 94 days, it's not going to hurt me by any means going that much farther out, so I'll just stick with it. Right now, you can see I have the 87.50.90 credit spread on it, so as long as we don't get a Market Club weekly red to tell us to get out of the trade, we'll stick in this for until we hit our 80% profit. That's Nike. SPY, I'm still in SPY. SPY was a little bit of a down day today, but you can see by the red, but still, charging up, which Travis and I have both been kind of a little cautious with this because this is a huge run up on SPY on the S&P on the stock market, and we're wondering when the bottom drops out of it. So I'm being a little cautious, but I do have positions opened up. They're about 0.5% of my account. So, and right now they're doing very well. As a matter of fact, one of my cash secured puts, because I'm doing the Buffett strategy. So one of my cash secured puts is almost at an 80% gain. So I'm going to actually buy that back and place another Buffett strategy cash secured put. I do have a 305 call option on it based on that Buffett strategy. And, if the market keeps raging up this year, that call option will end up making me some money. And if not, it doesn't matter because it's been paid for by my credit spreads. And as a matter of fact, when I buy this back and sell another cash secured put, now my call options are completely free. So any money I make on them is a bonus. So, and then I think my last one is, AT&T. Again, I own AT&T and I have some covered calls. They still have a lot of time left on them, so I'm not doing anything with them. My covered calls are at $32. I really don't want to part with this stock, so but typically you don't get assigned this far out, although I do have to. That is part of my trade plan. It can get assigned, but if I did get assigned, there's no loss here because I bought it at 32. I'd get assigned at 32, so it'd just be a gain. The good news is my covered calls weren't around earnings, or I'm sorry, the dividend payment. So I already got all my dividends on my shares, and the covered calls that are in the money will expire before the next dividend payment. So I can, if worst comes to worst, if AT&T stays around this 32 and it's going to be in the money, I'm not going to let those shares get called away. I'm going to buy those covered calls back for a small loss and then just rinse and repeat, because if AT&T is around 32, I can turn around and sell $34, $35 cover calls, make a little bit more premium for what I lost in the 32s, And if I did get called away, not a big deal, because I would then make even more money because I bought them at a lower rate. So that's it. That's where I'm at. I do have, there's a couple other stocks. I'm looking at Costco. You can see Costco it's all green across the board. It had a red daily the other day, and then it triggered for a red daily yesterday. So I'm most likely going to look at doing a credit spread here. I'll probably do a little bit shorter term. I'll stick around my 45-day time frame here. And I'm going to go kind of light on my risk right now because I just don't feel that the market can keep charging up the way it's charging up. But as long as it keeps telling me that's what it wants to do, I'll trade in that direction. But I'll go a little bit easy on my risk. So if the market does turn around, it's not going to hurt me. So that's it. You guys take care. Travis will kind of throw this into his video. A shout out to Travis. So I hope everything's going well. Hope your son is doing much better. I know his son was sick, so keep him in your prayers. So that's it, you guys. You take care, and we'll talk to you soon.
Alrighty, I'm back, and thanks for the shout out, Peter. No, my son's not doing better. Yeah, we're actually taking him back to the doctor now as I speak. My wife is to see if he should have been getting better by now because his throat is still swollen shut after, 4 days? So we don't know. We've never experienced that, so we're just trying to, with the other two kids, so we're trying to figure out the time frame when he should be healed and when the antibiotics or whatever they gave him should be kicking in. But anyway, thanks for that, Peter. I appreciate that. Now I'm back. Let's see if I can be respectful with your time. Peter had a perfect time length of about 10 minutes. And so what I'm going to do, briefly, I may touch on my trades here, but what I want to do is share something that I think a lot of new traders or a lot of investors struggle with. It's a mindset shift that needs to happen before they can succeed. And I see a lot of people disqualify themselves for my programs. And the reason we use Buffett strategy, all these different names, because I realized there were a lot of people disqualifying themselves from our program because they thought they wouldn't learn anything new. They're like, all right, for example, let me just show you a dialogue I had with a member. He did wind up joining, but here's a dialogue on the front end. This person wanted to know if this program was simply selling puts the Buffett way, our Buffett strategy. I've been doing that a long time. I don't want to waste anyone's time. If that's what it is, if it's something different, let me know, right? So he's focused on strategy. Is this a strategy you're teaching? Because if it is, I already know it. When the reality, the question, that's a valid question, but the reality should be, and you have to pull this out sometimes with people, the reality is not about the strategy, it's about the results. So notice I answered his question, but I refocus it back on results. I say, yes, at its core, it's that, meaning we're selling puts. And if you're already earning 15% in passive income each year from it without the huge drawdowns, then the trading won't benefit you, right? Because again, if you're using this strategy, you're already earning 15%, you don't have huge drawdowns. A drawdown is just when you lose a crap ton of money, right? That's the language sometimes people use. And I know that's a common problem for people who sell puts. So I was honest. I'm like, hey, if you're already doing this, it won't help you. But he said, no, I'm not earning 15% in passive income. Do you have any protection in place for market crashes and drawdowns? I got tired of earning a good income every month for months on end, and then 1 month wiping out all the profits. So I answered him back, what you face is very common, which is why I no longer trade options like everyone else. Our mantra is this: focus on risk first, profit second. Learn how to protect your portfolio, and then the profits take care of themselves. So I sent him a free video on insurance. I told him how he can pay for his insurance. Well, I said, hey, you can just join our program to figure out why we don't ride the profit and loss roller coaster. And if he's not through with what he learned, he can just simply ask for a refund. We don't want people to join something that's not a good fit for them. All right, so let me stick here for a second. So what he faced is common. People use that strategy, and yeah, they make money, and then 1 month will wipe out all years of profit, right? So you notice how he asked the initial question. He didn't say, is this selling puts? He didn't say whether he's successful or not. He was only focused on the strategy. He thinks he needs a new strategy. And I'm like, no, you don't need a new strategy. You just need a new approach or a new way to apply that strategy, because we're using that strategy. And if you're not earning that, then something's wrong with the way you're applying it. So I gave him a free video. I'm like, okay, here's how I gave him a solution, right? He's not even a member. I gave him a solution to these huge drawdowns where you lose money, a free YouTube video. Hey, here's how you protect your portfolio. All right. And then he said, hey, I watch it. Not sure why you would go long VXX considering it's biased to the downside since its creation. But I see you bought a put for protection and it worked out. I'm just wondering if the program is simply teaching us to buy puts on stocks we own. First, why I would buy this stock that was going down. I intentionally bought a stock that was going down in price. I believe I might have put that in that video. I know I put it in another video. It's because I was showing students you don't have to fear stocks going down. Yes, I bought a stock that I knew was going to continue going down in price. And I said, this is how you buy insurance. So I wrote that stock down for 2 years, lost about, I don't know, 40, 50, 60% of my money. I can't remember. It's in the video. And then I filed an insurance claim and got all of my money back. I walked away with a small profit. And so I was like, man, I gave him a solution. And instead of saying thank you or just realizing like, wow, he helped me with the issues I was having. And I was like, look, there's a mismatch in philosophies. He was still stuck on strategies and not results. He didn't just pay attention to, wow, I'm using the same strategies as Travis, but he's successful not losing money, but I am, and I'm using the same strategy. So I said, you're stuck on strategies, not results. Our members earn 15 to 30% a year on their money. You don't. And I didn't mean it in a derogatory way. It was just a fact based on what he told me. So I said, yet you still keep focusing on strategies instead of the results. The strategies you and our members use are exactly the same. So if you want to learn a new strategy, we can't help you. You're learning the same strategies that are taught for free online. But the reason we make money consistently and you're still struggling to find that consistency is because whoever taught you didn't tell you that success with investing has little to do with strategies. So lastly, he came back. Thank you for being candid. I was thinking that strategies produce results like an airplane takes you to your destination. It doesn't seem right to not focus on which airplane to fly, strategy, from San Francisco to Shanghai, as if when we call to make a reservation, we hear, oh, don't worry about which airplane. We might put you in a Cessna 152 or maybe a Boeing, but don't focus on that. Focus on the results. We'll get you to Shanghai. And I started laughing. I'm like, if the result is financial freedom and wealth, I don't care how the heck I get there as long as I get there. So yeah, I wouldn't care how they get me there. I focus on results. So he says, aren't strategies important? Don't they lead to results? Clearly, I'm thinking wrongly, so I'm going to give your program a try. It just seems very odd to consider selling naked or cash secured puts but not experiencing large drawdowns as a strategy produces those drawdowns, results, or simply buying puts for protection with this drag on results during an up market. But again, I'm definitely not thinking the way you do, and you're successful, and I'm not, so I have to change. That's his opinion, whether he has to change. And I don't think he's thinking wrongly, maybe misguided thinking, but it's common thinking. I've seen that. And I didn't say strategies weren't important. I said success has little to do with strategies. All right, case in point, we're all using the same strategies as him. We're experiencing consistency. We're not losing money. So yes, the strategies, if they were that important, our results should be the same as his, right? Forget me for a second. Let's look at Warren Buffett, the billionaire I learned this strategy from. This Buffett is selling puts just like this person was. This person is losing a lot of money. What is Buffett doing? He received premiums of $4.9 billion, money he has invested, right? If it was about strategies, then Buffett should be experiencing the same inconsistent results as this person. Same with me. We're using the same strategies. All right, looking at my performance this year, I don't have my whole spreadsheet. It's expanded here, but let's just focus on this part, right? There are people using the exact same strategies as me, but is their account up 74% for the year so far? No, right? There are people doing much better than me, I'm sure of, and I'm using the same strategy as them. If it was about strategies, our results will be consistent. There are also people using the same strategies as me, and their account is a little bit lower than mine. So again, it's not about strategies. It's about how you apply those strategies, right? Again, going back to Buffett, forget me. Buffett uses the same strategy as this person. Buffett is receiving $4.9 billion. This is his 2008 shareholder letter. If you read all his current shareholder letters, he updates you on these positions. Buffett is not experiencing what this person experiences here, where he's not earning passive income and he's not getting all of his profit wiped out in 1 month. Buffett is not experiencing that, yet they're using the same strategy. Not about strategies. Now, again, I said I wanted to respect your time. I wanted to do a deeper dive on my my strategy, my trades, but I want to make sure you get this point. It's not about strategies. It's about how you apply the strategy. So I'll leave with one more example. I wanted to have a PowerPoint and pictures of this, so just follow me verbally. There's a strategy called buying a car. I'm going to show you two different ways of strategy of buying a car. The first strategy is one that I used to follow, most people in America follow, is you buy a new car and you finance it through the bank, for 5, 6, 7 years, however much. Let's say you finance it for 5 years, your car payment is $550 a month. Right? At the end of those 5 years, where are you? Your $30,000 car you bought has depreciated in value. It's no longer worth $30,000. I don't know how much it'd be worth. So I was going to look up an example, but let's say it's only worth $10,000 after 5 years, right? So not only did you lose value on something you bought, you went backwards financially on that car you bought, but you also went backwards financially because you financed it. You are paying money to the bank. So at the end of those 5 years, after making a $550 car payment for 5 years, you're back at zero, right? You don't pay anything to the car, but you don't have any money saved up. You just giving it all to the bank, right? Here's another application of that strategy. The strategy, again, is buying a car. This is the application my millionaire mentor taught me. He told me, get rid of your car. It's a worthless, depreciating asset. It's not putting money in your pocket. Buy a used car that you can pay cash for, right? Then take the $550 you were paying to the bank, put it in a savings account each month for 5 years. During those 5 years, you'll be learning how to become a successful option trader on paper. At the end of those 5 years, you will have $33,000 in the bank, and you will know how to earn 2 to 5% each month on your money via options. Translation, your asset, $33,000 will be sending you checks of $660 to $1,650 a month. Then and only then can you get a new car. Let your friends look rich with their finance cars. I want you to actually be rich, and the only way to do that is to handle your money like the rich. See, there are two ways to apply that strategy. One is a typical way. Do you know anybody who, applies it, which method one, where you finance a car through the bank at the end of those 5 years? Most people trade in their car. You're back to where you started. Here's another way to apply the same strategy of buying a car, but this method makes you rich. Same strategy, two different results. And guess what? At the end of those 5 years, that person could keep putting $550 away. So in 10 years, they might have $60-something thousand in the bank. Now their checks will be double. Guess what? That other person with the other strategy, applying method number one, they're still on a treadmill each year, paying off cars that are depreciating in value, having to finance it again. This person made one small sacrifice on the front end, and they never have to finance a car another day, for the rest of your life. I know that because this is a plan I follow. Now, I know I've already received some pushback on this. People are like, well, when you buy a used car, what if it breaks down? You're going to be spending all this money fixing it up. Yes, I know people who have their argument, and everybody who has an argument is broke, right? That's just my experience. Why? Because that's the same argument I have when my millionaire mentor shared this with me. I just pushed back. Dude was rich, I was broke, but I wouldn't listen to him. I'm like, no, my used car might break down. I'm going to spend all this money fixing it up. Everybody who has that mental argument, it's not a fact, it's a mental argument, generally struggles financially, right? Do you know anybody who has followed method one of financing their cars? Are they rich or financially independent, right? Because all the rich and financially independent people I know, in some variation of form, follows this method. They have an asset sending them money every year and every month, and that is what they use to buy their cars and things like that. They're not living check to check. Again, this is not trying to be preaching anything. I'm just literally showing you it's not about strategies. It's always about how you apply the strategies, and how you apply it gives you two entirely different results. It makes a difference between success or failure, wealth or poverty. So get off the strategy mindset. It's never about the strategies. It's about your philosophy, how you think, and it's also about how you apply the strategy. And when you start thinking and applying the strategy like a billionaire, don't be surprised when more money shows up in your bank account. So you take care. Hope you have learned one nugget of wisdom, and I'll see you in the next recap. Bye-bye.